Hi, welcome back to my channel. My name is Mel DeWeese, and today we're looking at AI, blockchain, and insurance, and how all of these are being meshed together, and that there are signs and symbols and articles to go over to update everybody on how AI and blockchain could be transforming insurance. And with that said, I'm going to get into my disclaimer, which is that I'm not your insurance broker. This is not insurance advice. This is just education looking at the most recent advances in technology in these spaces and should not be used for financial advice or legal advice or insurance. And it's for entertainment, educational purposes only. Okay, so let's dive in because I am excited to see what the updates are as far as how AI and blockchain are being used in insurance. I have been working in for 20 years, and I watched the insurance industry transform through the Affordable Care Act, Obamacare, and that legislation drastically changed how I work and the plans that we were allowed to sell and who was enrolling on what and getting charged. I mean, it was a huge adjustment. And crypto did have some major legislation go through last year. And in 2026, it was anticipated earlier this year for the Clarity Act to go through, and that didn't happen. And everybody's kind of waiting around seeing what's going to happen with that. But in the meantime, we do have legislation on stable coins. So banks, insurance companies, the financial, a lot of industries connected to the financial sector are really investigating stable coins and trying to see how they can take advantage of making immediate returns on their money. And it's interesting to see how people are using it and when this could be fully functional for the average business out there. What the data shows, and there's been quite a few last couple of weeks that I consolidated here, and looking at the U.S. health insurance, it's concentrated, costly, and under fire. So recent research from NBER research, it's a U.S. health insurance. So it found that U.S. health insurance markets are increasingly concentrated in 2026, meaning that there's only a few players out there. I mean, there's some states you go to where you really have one insurance carrier to go to. And the idea is the more carriers that are competing for your business, the more competitive that market is. Insurance over the years, as legislation has gotten more restrictive and harder for new companies to start in, we've seen the competition dwindle down. Okay. And MedPAC report in 2026 showed rising employer plan premiums reshaping benefits design. And we did talk about that recently in some of my other health insurance videos, is that we're seeing inflation in medical insurance really tick up this year. We're seeing 16 to 26% increases in the insurance market. We did see, I think it was around 25% for most ACA plans, which were individual plans. However, many people were sheltered from those increases due to subsidies. But a lot of people out there are experiencing higher premiums year to date. Insurance scrutiny, so antitrust regulators reviewing insurer provider network arrangements. So there's been quite a bit of scrutiny over the years on how insurance companies negotiate with providers here, insurer and provider network. That's really just, provider network just means who accepts your PPO, who accepts your HMO. Your network is that group of doctors that accept the plan that you're on, and how the insurance companies negotiate with those providers has been under scrutiny for a long, long time. And a lot of people don't like that when you go to get an MRI, let's say, and they ask if you're a cash patient or if you have insurance, say you're a cash patient, they charge you, let's say $250. And then if you say you have insurance, they bill your insurance company $1,800 or $3,600. I mean, sometimes the discrepancies are crazy like that. Last year, I went through and did a whole report and showed the range of what people, what hospitals charge, and what that ranges can be multitudes, like 10 times as much as the cash price. And I would have to go back and reread it, but it was pretty drastic. My point is, there are reports out there that can show you this, that there is a huge price discrepancy, what providers are billing and to who. And if they're billing the government, if they're billing Medicare, they're billing one rate. If they're billing an insurance company, they're billing X times that what they're charging Medicare, and then cash is different. So anyway, there's scrutiny over all that. And employer plan change or employer design shifting to high deductible and HSAs is a cost control mechanism. That's been a trend for many, many years, ever since HSAs came about. And then we've got reference-based pricing adoption accelerating among self-insured mid-market firms. So reference-based pricing is reference based off of Medicare rates and how insurance companies pay out in a list of all of the covered procedure codes. And with claims, you have a specific code for every single procedure out there, and you have a specific code for every single condition. And if your condition and your procedure don't fall under that code, you're experimental and it's really not covered. And there is a code for that. It's like 999999 or something like that for experimental. If your doctor puts that in, it's not going to be, the company's going to say, we don't know what this is, it's experimental, and we're not going to cover it. So they have to have these specific codes to even consider covering the service that you had at your doctor or your hospital. My point is that there's a huge list of these codes, right? Every single condition out there, every single procedure, and then a book referencing each and every one. And Medicare comes out and updates what they pay their hospitals for all of these procedures, or what they pay doctors for all of these procedures, and what their reimbursement rate is for those specific procedures. And reference-based pricing comes around and says, hey, we will give you 5 or 1.25 or 2.5, whatever the plan determines. It'll say, the self-funded plans may say, we don't have a network. We're not paying an insurance company to rent their network, because when you're self-funded, you're paying all your own claims. This is for big companies out there that just pay. At some point, it just makes sense to just pay your own claims. And so these large companies are just paying their own claims. And they say, you know what, we're not going to rent a network from XYZ insurance company, from UHC or from Anthem or Blue Cross Blue Shield. We're not going to be renting any network. We don't want to pay that. So what we'll do is we'll promise, if you go to the hospital, we'll just pay based off of this reference-based pricing. And it's a ratio of, let's say, 1.5 or 2 or 2.5, or the plan determines is fair. It's just a fixed price. And that way they are negotiating with the hospitals directly to get the best price for that claim, rather than paying an insurance company to do it. My point is that these larger employers that are self-funded, that are paying their own claims, instead of paying the insurance company to rent their network and trusting the insurance company to negotiate to the best of their ability with their money, they may just say, we will handle that and we'll allot up to this certain ratio to negotiate claims directly with the hospital, and they may hire a specific third-party administrator to, they usually do have a third-party administrator that negotiates that for them, like Goodbill or some of these others. And instead of paying the insurance company to do it, basically. So this is just reference-based pricing that's been around for a while, and it's been adopted for a while with larger self-funded plans. Okay. So what this means for employers: benefits costs increase outpace salary growth, redefining total comp strategies. When we're looking at total compensation, so an employer, you may be paying an employee $25, but at the end of the day, it really costs you $50 to have that employee, because you've got payroll taxes, you've got insurance costs, workers' comp. So with total comp, really what the employer was looking at is what it costs to be working for them. And most employees think, oh, I make $25 an hour. My cost to my employer is $25. No, that is not the case. It's probably more like $50 or even more, because you've got payroll taxes, you've got insurance, workers' comp, and benefits, and a 401k, whatever other costs you have associated with that employee. And many employees are fairly ignorant to the total cost to employ them. So there's these things called total compensation statements that employers can implement to educate their employees on what they're really truly paying and what the true income is for the employee. So employers are looking at those total costs and really trying to evaluate that, because benefit costs are increasing faster than people's salaries, and they want to show employees, okay, maybe you didn't get the best raise, maybe you weren't happy about your raise, but look, our costs really went up this year on this side of things, and can show that more clearly to the employees in a very transparent way. Okay. More HR leaders now co-designing benefit plans with finance teams. And AI-driven plan comparison tools become essential for brokers, RFPs, narrow networks, and prior auth friction, driving employee dissatisfaction. So certainly is one of the topics that I wanted to talk about today, is how AI is completely changing how detailed we can be when we're comparing plans. More specific with exactly which networks are going to work for and their employees. Employers today have employees all over the United States, and even a small business may have employees in every state, or employees in 5 states or 10 states. And it can be difficult to make sure that all of those employees are going to be covered under your one insurance carrier for your medical insurance, or for your dental insurance, or your vision insurance, and so on. So brokers, and like myself, are really pulling and using and leveraging these AI tools to do even a better job at making sure that we are covering everybody on these networks, because the broader the network, the more expensive the plan. If you purchase a plan that has coverage with percent of doctors out there, that plan is going to be more expensive than a network that maybe only has 25% of the doctors in your area. But what do you care? If your doctor's in the smaller network, why not go on the narrow network plan? So that is really the question that we're posing when we're looking at these things. And of course, we have to know which doctors the employees want to see in this process. And either we can pull this from their current insurance carrier, which can be difficult to obtain, or we just ask the employees directly. And when I say we, I mean you, the HR person, because if I reach out to your employees, they're going to say, who are you? But HR reaches out with a simple question to their employees, asking which doctors are most important to you and your family. We're evaluating our plans. We want to make sure that your doctor is in the network. We can't guarantee anything, but we're really trying to make sure that we're, picking the most cost-effective plan for you and your family. Okay. And premium growth is 7 to 9%. So I know that Melissa, you just said that it's going up 18 to 25% this year. Why is this saying 7 to 9? Well, this is really looking back over 2025. And also, although a lot of people did get a 7 to 9% increase, some people got more, and the average renewal may have been more than 7 to 9%. The actual premium growth was only 7 to 9%, because even when you have a 20% increase on the table, the employer may choose to downgrade. They may choose to change their deductible, change their network, and for the most part, get the renewal down with those downgrades or those changes. So at the end of the day, the premium growth is 7 to 9%. And then wage growth was 3 to 4%. Employee satisfaction is falling, and high deductible health plan adoption went up 42% last year. Then we have AI in claims underwriting, actuarial analysis, and what's happening now. So with AI claims processing, Lemonade, that publicly traded company, AI handles routing claims in under 3 minutes, and it's live, and it's been like that since 2022. Trackable AI estimates for auto damage from photos have been deployed at USAA, the auto insurance carrier. And smart contracts trigger automatic payments on parametric triggers for weather and events, catastrophic events. And fraud detection with AI flags anomalous patterns pre-payment. So they're definitely using AI for security and fraud. And from what I understand, most of that is coming through third party. It's not necessarily always the insurance company doing it themselves. Oftentimes they hire a third party that is an expert in this area to manage this for them, or they buy a company that does it and then integrate into their system or into their umbrella. Underwriting workbenches live. So Coalition, fully automated underwriting for cyber risk, real-time pricing. There are some firms and some insurance companies that are automating their underwriting process and streamlining this for real-time pricing. And we're seeing it more on the sales side and the underwriting side to more quickly produce quotes and the like. That's really where I'm seeing it more from the insurance companies directly. You as the user may not see it, but me as the broker see it for pricing, which makes sense because a lot of these AI scrapers, you'd be amazed what kind of information these insurance companies have when I submit a census now. Like on some of them, I don't really have to give too much information because the insurance company has access to purchasing data and social media data, all sorts of data where they can predict how the purchases of someone, or they can tell if somebody's been purchasing a certain medication, their purchasing patterns and things like that, which is pretty crazy. And then we have insurance. They use home pricing coverage on live sensor data and generative AI underwriting workbenches, like I talked about before. Insurers staff use LLMs to structure. And Swiss Day Munich redeploying internal LLM tools for actuarial modeling. So lots of actuarial modeling. I'm seeing this definitely skyrocket in the last couple of years for actuarial data and predicting pricing. Agentic quoting and distribution is emerging. AI-driven quoting systems submit, compare, and bind policies with minimal broker involvement. YSX Tech partnerships announced for digital insurance transformation, March 2026. Embedded insurance APIs, coverage issued at point of purchase for travel and e-commerce. All right, and we've been seeing that for a while, definitely. So smart contracts and tokenized insurance are production ready. So smart contract insurance is live now. So we have Etherisk flight delay insurance, payout triggered automatically by Flight Data Oracle. That's a smart contract that's live now. Next is DeFi protocol coverage, smart contract failure insurance, on-chain underwriting. And Oxbridge Assurance Plus, catastrophic reinsurance securities, tokenized and tradable on Solana. Claims payment validated via Oracle networks, no adjusters, no disputes, no delay. All right. And then we have digital asset insurance markets driven by crypto, treasury, and management growth. The key players are CoinCover, Lloyd's of London, Crypto Consortium. So how many of you out there knew that Lloyd's of London had a crypto consortium? Coverage types, exchange hacks, key loss, DeFi protocol failure, stablecoin, DPEG. And those are the different insurance types currently. Institutional crypto custody now requiring proof of insurance for board approval. Traditional versus blockchain insurance claims. So in a traditional claims process, we've got you file, the adjuster looks at it and reviews it. It may be negotiated or have to be approved from the doctor's office, and it pays out in 30 to 90 days. Now with a smart contract, you trigger verified, smart contract executes and then pays out within minutes or hours. And AI assisted claims review, so AI triage plus human approved for, hopefully this would reduce that 30-day to 90-day down to same day or 3 days. And smart contract ledgers, generative underwriting workbenches, and agentic quoting systems advancing under tightening NAIC AI expectations. And that's the industry synthesis for 2026 so far. So NAIC AI governance is setting the rules of engagement. So NAIC modeling bulletin on AI adopted. Insurers must maintain governance accountability for all AI decision making and third-party AI tools. Sustainability requirement, AI underwriting claims decisions must be documentable and auditable. Okay. Prohibited using AI in ways that could constitute unfair discrimination under existing laws. State level adoption accelerating, 20 plus states considering or implementing AI insurance rules. Then we've got insurers using AI for employer group plan pricing, and then must show non-discriminatory impact here. And I've definitely been seeing that increase for sure. And it'll be interesting to see more on this because it seems like there's quite a push to level funding this year for smaller employers. So employers that I was told 20 or more, and then yesterday I was told 10 and more. Employees up to about 100 plus. I mean, obviously we can still level fund over 100, but that's really seems to be the market that many of these level funded products are targeting, is that 20 to 100, because in states like California, employers have to be over 100 employees to be considered large group. Other states, it's over 50. So those states that are over 50 tend to have level funded automatic built into that state insurance marketplace. And now with AI, these models are able to predict what the claims costs are going to be more accurately and more efficiently, and have less cost load on the actual plan. So we'll see how that all shakes out in these quotes that are coming up, because this is so, AI is, if you haven't noticed, AI is getting better, like way better all the time. And so every time I get a proposal, I feel like this is, a new way of doing it. It seems to be emerging quickly. And like I said, AI assisted prior authorization decisions can be challenged and appealed under new rules. Employers buying stop loss coverage must audit for bias. And then broker tech stacks using AI comparison tools need algorithm transparency disclosures, and AI can demand algorithmic expansion when AI claim denial affects employees. Self-insured employers using AI TPA tools face direct governance obligations. All right. So there are some laws or some rules and guidelines that employers are using to liability and make sure that they're following the laws of the land and doing everything fairly. So what insurers and employers can deploy now versus 1 to 2 years out. Available today, which are proven products, parametric claims payout via smart contracts, like we talked about, AI-assisted damage estimates for auto and property, automatic cyber underwriting, tokenized reinsurance securities, digital asset insurance for corporate crypto treasuries, employer benefit cost benchmarking tools using AI. And so what is realistic in the next 1 to 2 years? So what is realistic is agentic quoting systems, submit, compare, and bind with minimal broker involvement, and AI underwriting across all commercial lines with full regulatory explainability compliance. Employer group health plans co-designed with AI cost modeling tools, employer stop loss programs with on-chain reinsurance capital, real-time wellness, data feeding group insurance pricing models. All right. So that's what we're looking at. And the insurance transformation is real and it's happening right now. Insurance industry is undergoing the most significant structural shift since the invention of actuarial tables. Smart contracts pay claims in minutes, not months. AI underwrites cyber risk instantly, and regulators are writing the governance rules in real time.
Thank you for hanging out until the end. I will have follow-up videos on this over the next week, so please stay tuned. Hit subscribe to be notified on new videos that will be posted soon. Like the video, comment, and we will see you next time. Bye-bye.